Benton.
Happy Friday. Out of quasi-lockdown. The wall is being lifted, my friend. Hello, fellow Victorians, with the taste of slight amount of freedom.
Mate, you look happier already, my friend. It's good to see you're out and about. And the shackles have been removed for the happy Victorians. So, yep, happy Friday, team, gang. Good to see you guys dialing in. A few people jumping on, Andy. What's the wine of the week for you, my friend? I've got a bit of the old Penfolds, Canungra Hill. And I had a friend give me this wine bottle. It's 2006. Meant to be all right.
Is that the same one from last week? So is that 2006 with a week open?
Yeah, week open. I've been letting it air out or something, Andy.
just been letting it oxygenate or oxidize that. Yeah.
I only drink a glass of wine a week, and it's with you. Actually, I drank some more wine earlier this week at around my campfire when I did some mentoring. But
hang on, let's just before we get into it, ladies and gentlemen, I saw something pretty spectacular. I saw a mentoring live. So for those of you just joining in, Jason does these incredible television quality, not quite like this, but television quality podcasts. And last time I saw something that it was almost a little bit of a property investing meets Survivor. So talk to me about that, mate.
It was around the campfire. We did have an interview with a cool special guest, Bronnie Ware. She'd written a book, The 5 Regrets of the Dying, and we did a fireside interview chat with her, and also we did live crosses to Sam and Tab out and about. So it was pretty sweet, mate. A lot of fun, and we enjoy that. So if anyone's keen to join us Monday nights, every second Monday night, get on the mentoring program and you get a bit of the action. So there you go, if you're not already.
Mate, that was bonzo. I thoroughly enjoyed that, mate. Looked absolutely amazing, and another way of making finance and wealth fun, which I think is desperately needed in this day and age.
Absolutely. Well, big shout out to a few of the regulars. We've got a few already dialing in. Alison there, Jeff. Good to see you. There's a few people. I think these people are sort of behind some sort of private thing. I'm not quite sure how it works, but gang, hello to you, whoever you are. Julie fucking Fletcher, welcome to the show. Good to see you, Jules. And Alison's got a bit of a question a little bit later on, Andy, so that'll be awesome. But while we're at the beginning of the show, let's do the quick intros. And ladies and gents, Andy Fenton over that way. 20 years in the world of banking, financial planning, and the stock market extraordinaire. I've been around the world, London, New York, Sydney, and has settled in the wonderful place, city of Melbourne. Was the most livable city in the world for many years, but the last couple of years lost a few rankings. Dang, yeah. Down the rankings. Here's myself in the world of real estate. As many of you already know, it's my passion, the real estate world, and been doing that 20 plus years, helping all around the world. Yeah, there we go. A few of the sticky chops, Jason Fenton, Andy Winton.
Yep. Well, it's good to see there's more dyslexics out there. It's great to see. Yep.
Welcome, folks. Andy and I, like many of you may know, we kicked off with Wine and Wisdom during the COVID lockdown to help our respective communities stay on top of the ever-changing, the moment changes that were happening. We enjoyed it, and hopefully you guys too did it all. And so now we upgraded a little bit, called it Wealth and Wisdom. Andy's catch cry is a little bit more wine than wisdom, but we'll see if we can work out the wealth. And between the two of us, we debrief the week, hopefully on your behalf, when it comes to the real estate game and the world of business, finance, maybe a little bit of politics, but we've got opinions in that space, but I wouldn't act on them. But Andy, What did I miss? Did I get a trophy for the week?
Mate, I reckon you've covered all bases, brother. It's almost like you've done this before, maybe 50 times. I'm thinking
50
it
times.
might be.
Yeah, there you go. Well, it's our half-century birthday or something like that. 50 episodes, almost a whole year's worth of episodes. But yeah, there you go. Good to see a few people popping through. Sean, hello to you. Kevin, good to you, my friend, and a few others. We got a question from Brian, and we got a question from Alison, and certainly team gang, stick with us. We will answer those in the question section. What we do, ladies and gents, is we have about 3 bits in the show, which means we do a quick brief, a touch base on what's in the news. That's who usually starts the show off. Then we do things you should know. There's a couple of things that we noticed this week that we might want to sort of do a bit of teaching and hopefully, communicate some ideas that we all need to learn. And then at the end, we'll do some questions. So, Andy, I might kick off what's in the news this week. I know you've got a couple of bits and pieces, but I thought I might jump right into it and sink my teeth into it. But what's in the news? It's really interesting. Well, it's more good news. What's in the news when it comes to the world of real estate at the moment? But team, gang, Andy, there's good news all around. There's good news here, there, and everywhere when it comes to the world of real estate at the moment. There is growth in every town, nook and cranny when it comes to the real estate market in the Australian marketplace. And funnily enough, some crazy places, Andy. I don't know if you can sort of see this right now. Gang, have a look at, the winner over the past 12 months. Have a look at who's busting out, big numbers. You're looking at Darwin. Are you kidding me? Like, I don't know. Darwin's not a city as far as I'm concerned. It's a little town. But, at the end of the day, what you can see here, team, this is in the news. Good news all around. People are getting richer when it comes to their property values and equity right now. Andy and I talked about it for quite a while over the last 12, 18 months. We have a supply issue literally everywhere in Australia, and property prices are going up. Predominantly, there's 2 reasons those property prices are being driven up. And I might talk about those in a minute. But, gang, have a little look at this one. Sydney, Hobart, 3% in the last month. I did a bit of a live, Andy, probably about 2 weeks ago. The average Sydney house went up $40,000 in 1 month. I think it was 100. Yeah, 150 grand in just under 6 months in Sydney, and that's just crazy numbers. Even Melbourne, while it's in the 1.8%, even Melbourne with lockdown and compressed and suppressed rents because of extended lockdowns, Melbourne's had, let's face it, in relative terms, not compared to the rest of the world, but in Australian terms, it's had the tougher time of it when it comes to the lockdowns, and its property prices have been extremely robust. The auction clearance rates have been extremely robust as we look at this. But listen, part of what's in the news, this is a good news story. What could we do about this good news story? For me right now, team, Andy, people should be locking in their equity. Borrowing's pretty easy. I helped a client just lock in a 4-year interest only fixed interest rate loan at 2.4% for 4 years just now on an investment property. That on that same investment property, that would produce, I did the numbers, it was insane. That would produce $13,000 of pre-tax positive cash flow, Andy, on a brand new property at those interest rates with a 5% rental yield. It was insane.
He's going to have to kick the tenants out, otherwise he's going to end up with a tax problem.
Yeah, I know. But thankfully, if you buy new, you can get depreciation, and that sort of washes that through. So not only did they get extra positive cash flow, they could actually claim some extra tax back. But anyway, that's what's in the news. It's good news stories all round. But I just want to dovetail that one for me, Andy, into maybe something, what you should know, team, in a second. But before we dive over to what you should know, on the back of this data, back of this information, what I'm seeing right now, Andy, I know you said you're seeing a little bit of it as well, is there's kind of the media's got sick of the doom and gloom. Hey, listen, we think the world's going to end. Nah, hang on. The property market's booming, and already I saw on the weekend in the Fin Review, we should tax property more. Property investors, they're the scourge of the earth. We're seeing it again. So, it doesn't take long. It's probably only been 3 or 4 months, and they've turned on us already. We were, but they like something to be the source of their news, whatever that news is. But for you guys and for anyone listening in, watching, or looking at the news, I've said it many times. These tin pot turkeys who are just sort of opinion pieces just because they want to write something, an article, don't get too invested, don't overreact, in that space. What we want to have a look at is some facts when it comes to the property market. So here's one fact that I think we should all sort of really get a hang on, which is annualized housing price growth versus the wage growth when it comes to, our world. And, many of you guys, if you're not already noticing, there's a large disparity of how can wages grow only 1.5% and property prices can grow, between 16 and 30%. Team, gang, what the hell is going on here? All right. And I think, Andy, you and I might have touched on this last Wine and Wisdom, but interest rates have really gone from 7% down to 2%, right? So the cost of a mortgage out of that wage has actually decreased, and as we know, unfortunately, most people will pay more than they should for real estate. They get caught up in the excitement of it. Owner-occupiers always pay more than they should. They pay over what, potentially a property is worth on the day because they're emotionally invested. The compression of the interest rate has allowed the property price to rise. It hasn't taken more percentage out of people's wages. Matter of fact, it's actually cost less cash-wise to own a property today than it did in 2012, a comparison price property, because the interest rates are so low. So team, gang, that's part of my what you should know right now in the market. Those property prices have got some room to move. There's some undersupply. There's cheap money, but those pressures will cool off when the rental yield starts to hit around that 3%, and you're seeing in places like Sydney, you're seeing in places like, some places in Melbourne, those yields are getting quite low, but other places like Hobart, Darwin, Brisbane, Adelaide, even Perth have got higher rental yields in locations. So those places have got technically more compression available to the rental yield. Whether people will take that risk, Andy, most of those locations historically have never been compressed in rental yields below 4%. But the marketplace in Sydney and Melbourne, will eat a little bit of negative cash flow because they believe the growth is there in those two power cities. So, for listeners listening in, that's why we're getting this growth, because interest rates are so low, and we do have, a little bit of supply issues and a few other things. And construction prices, ladies and gents, brand new houses and apartments and townhouses, it is very clear right now that construction prices are going up between 5 and 15%, Australia-wide. So that's going to really push up the prices as well. So, that's about it from me from what's in the news, Andy. What about in your neck of the woods, mate?
Well, mate, I'm tossing up which way do we go here, because there's a couple of great questions that have already been dropped, and I fear that if I go into what's in the news for me, that we might see out 8 o'clock tonight, and I may not have finished. So I'm tempted to jump in on some of the questions that we've actually had across the desk. What do you reckon? Do you reckon we just mix up the order for a little bit and just jump into a little bit of Q&A in the middle, and then we'll come back in? And for those of you who aren't interested in the questions, which are great questions and they're very impactful questions, let me let you know that there is some serious stuff installed in the next 30 minutes. I can tell you right now, and it's we're not going to pull any punches.
Buckle up, Dorothy. We're going to Kansas. All right. Well,
right, that's exactly right.
So Andy, look, where should we attack this? Let's have a crack at Alison's question here. I have a question for Andy. What is a capital note? Yeah, go for it.
So I don't know too much about the most recent set of capital notes as far as ANZ. But typically when they release capital notes, so if you're a shareholder of ANZ, typically what happens is that they might issue investors looking for fully franked dividends, income away, or potentially a floating rate of distributions. They'll send you out an opportunity to invest in an offer, and they call these things capital notes. And effectively, they're a little bit of a complex investment. You've got to look behind or underneath the hood of these things, because effectively what they are is they're a way that a bank can raise capital. So you've got 3 different types of investments effectively in a bank, right? People always say, don't put your money into a bank account, invest in the bank, because they've got really interesting ways of making money, and they really do. And well, let's not get into the ethics of it. So you can.
You're all weak about that one, Andy.
You can choose to invest in the stock itself. So ANZ, buy ANZ shares. It'll pay you probably somewhere between a 5 to a 7% fully franked dividend over a course of time, depending on what level you buy in. And look, you're going to get a large amount of volatility, but over a historical point of time of 30 years plus, you're probably going to be getting somewhere in the vicinity of a 7 to 12% return over that per annum over a long period of time. So, but you sacrifice and you go up and down in value, and you get your dividend. Now, capital notes, and these things are called different things. You might have called them called pearls, which is great. Some marketing person probably thought, oh yeah, we'll sell pearls because that they didn't shit themselves over in WA as far as investment schemes went.
Call them pearls.
So we'll call them pearls. But effectively, these things you got to read the fine print, because they can be what is it? A sheep in wolf's clothing, or a wolf in sheep's clothing?
Clothing, Andy. Yep.
They tend to have the characteristic of debt. So when you go top side, you've got equities, large amounts of returns, larger amounts of volatility, and some fully franked dividends. Then you go the other side of how banks raise money, which is where they issue debt to the market, which is like a government bond, only it's issued by a bank. And they say, well, we'll lend $100,000 and we'll give you the cash rate plus X amount of basis points, which is percentage points of interest, so 0.5% over the cash rate or 1% over the cash rate, and we'll give you that. And basically what that means is the bank has to fail in order for you not to get your money back, broad terms, right? Give or take, right? So capital notes can have different types of attributes to them, and so that they can have the attributes of equity and also debt. And this is where you really want to look at them. So the things that you need to be looking at is they will have sent you through an information document, which will tell you that what your strike price or what your buy-in price is going to be. And then they will tell you whether you're getting a fixed rate of return or a floating rate of return. And what that means is if it's a fixed rate of return, they'll say, we'll give you 6% for X amount of years. If it's not, they'll say, we'll give you BBSW, which is the bank bill swap rate, plus a percentage. And you can Google the bank bill swap rate, and they'll say that we'll give you a percentage above that, and that'll go up and down over time. And here's the sweetener, is that quite often with these things, they say, well, we'll convert these into shares at a point in time. We'll either pay it back or we'll convert them into shares. So they can be pretty complex. So you've got to read the paperwork behind them. But quite simply, they are. So here's the thing. Read the paperwork, get to understand it. If you don't understand it, reach out to somebody who does, or don't invest in it. All right? If you don't understand it, don't invest in it.
Andy, let me ask a question. Why would they be looking to raise more capital? Is it because they can't buy it from the market? They think they can get it cheaper from their own users of their own product, or customers of ANZ? Like, why would they be looking to get it from Allison rather than buy it from another provider or a professional investment house?
Well, it's the fastest way to raise money is to go to people who you already have money from. Yeah, people that you know. All right, it's the fastest way to raise money. It happens very, very quickly. Also, people are committed to you. So psychologically, there's a greater chance that you'll get money from those sources that have already done business with you. So it's a lot faster. If you raise cash by creating more shares, you dilute the share price, which means that the other shareholders that you've got will get a bit pissed off because that'll devalue their shares. So that they don't want to do that. As a matter of fact, now they might want to be buying their shares back. Right, so they might want to borrow some money for a cheap interest rate, buy their own shares back. Now that's a whole different story, which we can go into.
Yeah, we've seen that before, haven't we? Yeah.
Well, we've seen about 6 months of it overseas in a massive way, because when you can borrow money at like virtually nothing and buy your own shares back, which is great, and then your company's doing 20, 30, 40% per annum, you paid 1% to get a 20, 30, 40% per annum return. Happy days. Allison, have a look at it, because they're complex instruments. They appear to be quite simple, but here's the thing. They have attributes generally of equities and debt, and they're kind of this hybrid vehicle in between. So you want to know the duration. You want to know how it's going to convert at the end, whether it's going to be a cash settlement, which means back to you, or it's going to go into becoming shares. And you want to know what the interest rate is over time. Is it fixed, or is it linked to something else that's floating? And then that will help you. Quite often, if you're able to take the risk longer term, you're probably better off just investing in the bank itself. But you need to take advice from your professional with relationship to that.
Nice one, Andy. Well, Allison's very, very appreciative of that explanation. We do. There's a couple of questions tonight, which is awesome. Maybe we'll do a few in turn here. This one's from Anita. Great to have you flying in from wherever you are, Anita. What do you think of the NDIS property? Listen, Anita, NDIS is absolutely fantastic. We've got a bunch of our clients, really enjoying the NDIS returns. For those who don't know, NDIS, National Disability Investment Scheme. The idea that the government has invested pretty significant amounts of capital in helping those who are a little bit more disadvantaged when it comes to their living arrangements, live in regular everyday houses in the middle of, regular everyday communities. If you want to understand what NDIS is, do a little bit of research. But it's a fantastic government initiative. Not only does it save the government billions of dollars, but also improves the life of the lifestyle and the life quality of life of people in that world. But NDIS, from an investor's point of view, Anita, absolutely fantastic. Unfortunately, as with all government schemes, the pink bat scheme, the this scheme, the that scheme, there are some absolute shocking operators out there just scamming and raping and pillaging. Excuse the French. Plundering and pillaging is probably a better way to explain it. They're not really there for you. They're not really there for the provider or the user of the NDIS property, they're there for themselves and they see an opportunity to get the cash and dash. You've got to be really clear and understand what that looks like. So certainly we have some excellent experiences with our clients and the customers of those clients in the NDIS space, and returning double-digit returns for the investors, and very happy clients with brand new properties and excellent living conditions. So I'm a big fan. However, the people you choose to do it with, your delivery team, your expert team, you need to really understand who they are and what they stand for, and I always check, little sanity check, Anita, if they haven't been around for more than 10 or 15 years in real estate, then I'd probably move on, to be honest. Anyway, maybe that's because I'm biased, because I've seen so many horror stories over my 22 years in real estate when it comes to this stuff. But to answer your question, NDIS is awesome, but you have to have a really proper professional team to deliver that bit of real estate for you. So hopefully that answers your question there. So hey, Andy, we might throw this one. Brian, all the way from Singapore. Brian, great you could join us, mate. Always good to hear from you. Hope you're awesome and well over there in Singapore. But Andy, any thoughts on this one?
But I do. Before we go into it, though, in regards to the last question, my experience in the investment world, non-real estate, is that effectively when it's government regulation or when it's government legislated and it's in a government incentive that gets put in place, it's all care, no responsibility, and then they turn their back on it, and there's no regulation around it, and you can, with a great intent and initiative, you can have that get bastardized very, very quickly. And the problem is that sometimes these initiatives are extraordinarily good, but people take advantage of them and they go the wrong way. And then the government comes back in because they took their eye off the ball. So they legislate, then they forget about it, and they come back over and go, well, hang on, you're finding every advantage to that to make it a commercial venture for you, and then they regulate.
Yeah.
And the biggest challenge there is you've actually got to find the people, in my opinion, one, who want to do it right from the beginning right to the end, because there tends to be a lot of commercial advantages that pop up with these things that make it easy for people to make quick money and make it easy for people to synthesize returns and make it look better than what it is. And in my experience, simple, stupid, and I know nothing about the NDIS side of the equation, but whenever the government come in and incentivize things, you've got to be really careful about who you deal with it, because there's smart brains that can make quick, smart money, but it's generally for themselves.
Right.
So this is an interesting one, and this is going to be in the press a lot, right? US inflation. And I think if it's of interest to a lot of our viewers, please drop some comments in, because this is we're going to hear a lot about this in the press over the next year, next month, next 3 months, next 6 months, next 12 months, next probably close to a decade, right? Because everyone's got their thoughts on inflation. And the reality is that inflation is going to happen. Like, it is an absolute, it's a necessity.
Yeah, I was going to say, Andy, it's required, right? We need it. Well, depends on how deep we want to go on this, but the system needs inflation to fuel the process.
And look, in a capitalist society where we kind of operate, we're going to see inflation, but we also need to understand, and we've gone into this previously, is where's the inflation coming from?
Yeah.
Right. Is it coming from because it's being pulled in that direction? And I'll give you an example. So supply chain logistics, of which we're getting an incredible member of CBRE on in the not too distant future to chat about supply chain logistics, one of the top in her game. Supply chain logistics, what that basically means is product from warehouse to product to your pocket, right? And everything that goes in between. Now, you can imagine in periods of time of COVID that the cost of that has exploded. potentially, and the time has exploded between you being able to get it because of everything that's happened in between. Ships are being docked off coasts and all of this sort of stuff. So that's one way of inflation, right? Because it's costing more to get the goods from that place to you. And then there's the cost of inflation in materials, whereby there's not as much of it around and there's a large amount of demand for it. Or there's a scarcity, a genuine scarcity, as in there's not much of this stuff left, like gold. And all of a sudden, the lack of being able to get it pushes the price up. That's another type of inflation. So what we need to sort of understand before we start to throw around, okay, inflation figures and so on and so forth, we need to understand where they're coming from and what the inflation relates to. Because there's some inflation which is extraordinarily good. And one of the inflations that you want to see is you want to see wage inflation. Because wage inflation, although it's not great for small to medium businesses, unless the inflation on the other side, unless there's the product and service inflation, which is the average cost of services and products increasing, then if wages are increasing at the same rate, that's all good. And so here's the thing, you're going to get given a whole lot of inflation numbers. And I think, Brian, maybe what we'll do is we'll do a big inflation session, and we might even be able to get an economist in to chat about it. I'm just thinking of somebody who would actually offer an opinion on this. And we can chat about all the different types of inflation, because you're going to get thrown a whole lot of bullshit statistics, I reckon, over the next 6 to 12 months, which are going to serve whatever the story is. Yeah. And here's the thing, inflation is good. Inflation can be bad when it's operating in the opposite to other types of inflation. And that's really what we need to be worried about. And here's the thing is that, like Jason said before, there are certain dynamics at play, whereas if property prices continue to go up, well, we need to see wage inflation. Otherwise, we're going to see this rental or the ability for your average punter to continue to pay the rent is going to diminish because their wages aren't going up enough for them to afford their rent. So there's two things that happen. They become homeless, or they move, or the rental yields on the property compress. But you've got to look at the opposite side and you go, well, actually, the result of the increase of the asset value has been so significant that money ends up getting redeployed into the economy. So, look, we're going to see it. The reason why, Brian, that people are going to throw it around is because inflation is the big, nasty word that's going to knock stock markets around. And whenever there's a crash or whenever the markets freak out, it's going to be on inflationary fears. So it's going to be an incredible headline over the next 6, 12, 18, 24 months. And the idea is that you want to be able to see through it because great opportunity. And if we do go into times of high inflation, wonderful. You know, one of the best assets to be in is generally property or inflation-linked bonds. There are places that you can go to jump on the inflationary bandwagon. But you just need to understand that not all inflation is made the same. Hopefully I've articulated that well enough, and we will come back because I think it's a really key point that we need to be talking about over the next year and beyond.
Absolutely, mate. Yeah, inflation, like you said, it comes in many forms, right? So, you know, we need to understand what form is maybe an abnormal form that we need to maybe be cognizant of, and maybe what's a normal form that we might need to be cognizant of. But Andy, David's give us a bit of a shout out here about sort of wages going up, and I've got a little slide here actually from you and I heard from Bernard Salt of just recent times, and I might show this one here, fly us in and see if we can do something. I might just hide David's comment, but one of the challenges has been not all wages are going up or down, David, and so the challenge for the moment, prior to COVID, we had some other challenges, but throughout COVID, the job losses, mostly the young, the unskilled, and the migrant, right? And so, for many of us, there's this tale of two challenges, Andy. You and I have experienced this in our business networks as well. Certain businesses have just exploded and gone crazy, and certain businesses are out of business right now. They're winding up and they're having some, challenges, and you and I are helping people through that. But cafes, shops and services, personal services, travel, these things that really have been hit hard by lockdowns, by COVID restrictions, by travel issues, by tourism, those ones, aren't recovering that fast, if at all, for the short term. And they've still got some, headwinds in jobs and wage growth, David. But, some of the places and spaces that are, getting some really interesting, uplift and gains in jobs and will be gaining in wages. And this is where kind of, Andy, I'd be curious, it'd be curious to see some of that statistic, separated out rather than one big lump sum. Be interesting to see these industries separated out in job growth, because I would say, David, and this is kind of linking back to where you are, nurses, at the end of the day, health and medical, jobs gaining. So I would be saying that, there would be no reason, why those health and medical industries shouldn't see income or job wage growth in this sort of space, because the pressure's on. There's requirements, there's needs, there's more, there's jobs, there's demand, across logistics. Andy talked about it before, technology, health and medical, and agriculture. This is where the job growth is. And often where there's job growth, there becomes a gap of enough people. And especially when we don't have enough people coming into the country, Andy, through immigration and other things, that would then give, the people with jobs a little bit more negotiation power to grow their wages, you would expect. Those sorts of things. So I thought I'd sort of maybe, show a couple of those stats. Andy, you got any sort of opinions on that one?
Yeah, not much more than what you've, well, actually a lot more, but not enough to go into today. But the one thing when we start to talk about inflation and job inflation and all of those sorts of things is that we've got to understand that one of the key metrics that the Federal Reserve over in the US and the Reserve Bank of Australia, they actually target inflation figures. So inflation is actually extraordinarily manipulated. And it's manipulated by the government, and it is by the Fed and by the Reserve Bank of Australia. And so it's manipulated by policy.
Quick pop quiz, Andy. Folks.
Oh, shit, here we go.
All right. Which bank in Australia actually started out or divided into, over time, the Reserve Bank of Australia? Which bank actually? There's a bank that was the Reserve Bank to begin with in Australia's history. Anyway, I just thought I'd chuck that one in there. Let's not answer it right now. If you guys are listening in while Andy continues his explanation, put it in the chat. Tell me if you know which bank. And no cheating on Google.
I think the question was in the answer, mate. But
you did right. Alison nailed it anyway. There you go, CBA. Just so you know, folks, the CBA was the Reserve Bank. Until they separated many years ago. Sorry, Andy, jumped in on you. There's too many clever people on our call, mate. Everyone nailed it.
Well, so here's the thing: is that it is the fear of inflation in the wrong areas for the Reserve Banks and the Federal Reserves. It's the fear of inflation taking off where they can't control it, and that's really what should be talked about. But it's not actually what is sort of spoken about. You just see the headlines. And quite often you're going to see things called, long-term bond rate spike due to inflation in fears, and then the share market's going to have a big, write down over a short period of time. It's going to be noise until it's not, right? And but while you've got the Reserve Bank and while you've got the Fed actually controlling inflation, it's really quite stable. Literally, they up until COVID, they were printing money in order to be able to maintain and control inflation over time, and that's what they've been doing since, I think, the mid-90s or thereabouts. Can't coin the date myself. It was probably while I was still at school. But anyway, so we will I promise we'll do a full thing on inflation, because it's important for business owners to understand inflation as well, because it relates to how we price our products and what we can expect our wages to do over time.
Mate, totally. I mean, at the end of the day, Andy, we've got a business question here from Jules, and we'll sort of maybe dive into that one. But, team, you employ someone this year and, they get good at their job and they want a pay rise next year, which is fair enough. That's a type of inflation. Maybe they're not doing anything more than the job that you employed them to do, but now they want, to be paid more, because they've been here longer and those sorts of things. So we need to understand what those sorts of inflations are, whether we're property investors, whether we're share investors, whether it's, affecting our super, whether it's affecting our businesses, or all of it. Because arguably, Andy, you and I have talked about this. I'm a fan of, if the government could borrow another, billion or $1 trillion, low debt, I'd hook in. I'd put in infrastructure projects till the cows come home around Australia, because we need another 10 to 20 million people in Australia to make this country, really solid from a tax base, taxpayer income. That'd transform this country if we had, that many people when it comes to a tax base. But there are some pretty significant arguments to, the environmental impact of those sorts of things. But if we were clever, we could increase the density in our cities to accommodate 10 million people in a flash and not go anywhere near the rest of our environment in Australia. So, you and I talked about that. But we've got a question from Jules here. Quest to find a great accountant, get her structures right. That I now find the banks don't love me. Yeah. Welcome to the world of...
Do you want to take this one, Jace? I'll come in after you, mate. But I'm going to tell you one thing, Julie F. Fletcher, is the banks don't love anyone. Nobody cares, and the banks certainly don't care.
No, they're it's actually, it's almost a soapbox moment, Andy. I might sort of rise up and get on my soapbox. I should have one here so I can stand on it. But it gives me the shits. As business owners, that you get treated like second-class citizens when it comes to borrowing, at the end of the day, because our incomes are connected to things that banks consider maybe a little bit unstable, they want to treat us, very averagely when it comes to borrowing. Jules, that is a real issue that you have to manage and deal with. One of the things that I do know, Julie, and for those who are listening in, and it's actually irrelevant whether you're a business owner or a PAYG who wants to increase their income through other means, because you might be an investor adding investment income to your income as well. The banks, treat it weirdly, if it's investment income or business income. But, at the end of the day, some strategy with the right lending team can make you look a little bit more attractive. And let me tell you, Jules, yep, there's my soapbox. Nice, and that's it. We're going to do it as we go. But, Julie, most likely you'll end up borrowing with the non-banks or the secondary banks. Now they're not bad. They're not bad lenders. Matter of fact, they're as inexpensive as the mains. But our sort of, we have this kind of this thing in Australia where we believe, we should be dealing with the banks. And team, there's 113 institutions that are professional lending institutions in Australia. 113. And if I asked you guys right now to name them in the chat, most of you would probably get to 5 or 6. So, at the end of the day, Julie, banks, they're not your friend, unfortunately. And, that's a real pain in the neck. But you need to make sure you look decent to the lender you're going to work with, and you're probably going to have to choose a different lender. So, but yeah, no, it's a real pain in the ass. And, it really irks me, soapbox moment, that we get treated pretty averagely when it comes to borrowing as business owners. I think that's really shit house. But at the end of the day, nothing we can do about it, Jules, other than get our strategy right and work with the lenders who are going to appreciate us. So, Andy, you got anything to add?
No, other than to say that it's not that way around the world. And it probably dovetails into what we're about to go into shortly. But just to mirror the strategy as a business owner, if you want to minimize tax at all opportunity, but you do want to acquire and you do want to do real estate and you want to get good lending out, you actually need to put some serious thought into when. And impulse buying, you can't do it. Or maybe you can do it because it's in the right year. There are some ways in which you can manipulate the scorecard to your favor a little bit more, but ultimately the rule of thumb is going to be your taxable income becomes your lendable amount.
Yeah.
The greater the taxable income, the greater the potential that the greater the amount of loan you're going to be able to get. And sometimes you need to take a year's worth of pain in order to be able to implement the strategy. But there's nothing. It's 1 year in 10 is nothing in the greater scheme of things. The biggest challenge is that it's going, okay, well, I want it, yes, as a part of a strategy, 100%. Do I want it now? Well, if you want it now, there's always going to be ramifications to getting it now, especially as a business owner. And one of those is going to be tax. So with Jason, I think that as a business owner, if you really want to get into these strategies, then you pick the year. And sometimes it just happens because you have a gangbuster year and you go, okay, this is a year and we're going to paper it and we're going to get the loans and we're going to have to take a bit of a haircut as a result of it. But that's okay because we've got a strategy long-term where we're going to claw that back. We're going to claw that back and we're going to claw it back in spades and we're going to make it hurt. We're going to make the ATO hurt that they ever allowed us to do that.
What's it called, Andy? Is it called dollar cost averaging or whatever you call it in the world of share market? So you might pay more tax this year, but over the next 10 years, that dollar cost average, if you dollar cost average it over 10 years, now you're gonna crush it. So yeah, there you go. Yeah, Jules. Sometimes you do got to pay a little bit more, Jules, to get the deal done. I'll give you an example right now, guys. Shay and I bought a couple of properties in the last few years. We've had to pay, a little bit more than everyone else is paying. We're not getting the 2.4% interest only loans, because, as a lending risk, the lenders look at me and Shay and go, what the, multiple trading companies across different countries, income sources from all over the place, many millions in borrowings, etc. But, if we can get a 4% loan and we know this real estate's really good and I can get a 5% yield, then I'm buying the property. I'm going for it. Shay and I have to put a 20% deposit down these days. We can't borrow at 90%. But, at the end of the day, it still works. So, way you go. So, yeah. But Jules, it's not. I always say this, Julie. It's just for now, not forever. Okay.
Yep.
So that's kind of probably what Andy was saying. We eat it today, but later on we'll be happy as Larry. So we grin and bear it today.
And here's the thing: is that there are ways that you can have your cake and eat it, but you've got to. It's got to be part of a strategy.
Yeah.
And it's not short term. It's got to be something where you go, okay, let's develop a 3-year strategy to acquire a property. And then, Julie, you can pretty much have whatever you want because you can manufacture the results. Of course, you're going to be victim to whatever the time and circumstance is, but the chances of you being able to get that utopian result is well within grasp. But most people won't allow a 3-year strategy. It's instant gratification and it's I must have it now. And that is the biggest killer. And it's pretty much exclusive to Australia. Well, actually, it's not exclusive to Australia, but I don't know every country in the world. But certainly in America and Europe, it's very, very different.
Well, Andy, I think both you and I have toyed with, number one, starting our own small business political party, and number two, starting our own small business bank. I actually think that'd be an absolute cracker. Maybe we start a credit union. Small business owners will lend to ourselves. Instead of treating us like second-class citizens, let's come up with our own version of lending. It's not a bad idea. I reckon we'd get swamped with applicants, that's for sure. So maybe we need to write a few of these ideas down so we can put them into play one day soon.
Right, we do. Oh God, you're getting me fired up right about now.
You're getting fired up. So I got this one from Chris. Hey Chris, great to have you on, mate. Hopefully you're still here, all the way in from Positive Real Estate TV in the YouTube land. So it's good to have someone dialing in on the live on YouTube. But he's sort of saying, want to build a property portfolio. Which names do we buy our properties in? I'm married, wife, and I'm the only one working at the moment. So, Chris, certainly when it comes to buying investment property, as we have a look at it, one of the important decisions to make is who is the owner of that real estate. And there's a few reasons, there's a few things that we need to understand are going to sort of dictate that. Number one, the borrowing and the lending we talked about with Julie just a minute ago. Whoever's going to be on the purchase of the property and also on the loan, you need to be able to qualify for the lending. So obviously, if you added your wife right now to the loan, Chris, that wouldn't add any value to the lending at the moment. It would actually be a negative. And by default, when the lenders ask for dependents, they'll analyze your partner as a dependent if she's not working. So, that's just one little thing aside right then and there. At the end of the day, if you are a PAYG earner, Chris, if you have a job, your risk is she owns all the real estate team. She owns pretty well everything. Actually, she owns everything. So I get to live in her properties. So she keeps reminding me, which is a good strategy. Chris, mate, if you're the earner and you've got a job and you're pretty safe and secure in that job and you don't have much in the way of personal risk, then buying in your own name is perfectly fine for the first 2 to 5 investment properties. And it's actually very efficient from a lending point of view. It's very efficient from a tax minimized point of view. Okay. So, Chris, other than that's not advice, mate. So don't sort of run off and do stuff without catching up with your, lender or your coach or your property expert or whatever it might be, your financial planner, accountant, whoever you rely on. But mate, for most people, their first sort of 2 to 5 properties, if you've got a full-time job and, you do whatever and the risk of that job is not direct to you as a personal risk, then owning property in your own name is very effective lending and tax minimization wise. So, mate, that's what I'd say. Give us a shout out if you want a contact or two to sort of talk that through with. But mate, that'd be my feedback to you with your question, buddy. Hopefully that helps as we're rolling through these questions tonight, Andy.
Well, mate, seeing as we're pumping through the questions, I'm going to jump back to what's in the news because we're just past 6 o'clock. But mate, I feel like we've only really just started. So let me start. I promised all of you that we were going to get to this point in time, and there's a couple of things that have been rattling me through the middle of the week. So let's just jump into what's in the news from me. And so what I'd love to know from all of you out there is, and I'm just going to take myself off the screen for a moment. So what I'd love for you guys, what do these two blokes have in common? So whack it into the chat, whack it into the comments field, wherever you are, in YouTube, in Facebook, wherever, whack it in the chat. What do these two blokes have in common? I did, when I posed it to one of my clients earlier on today, they said they've both got 2 thumbs and don't give a shit. That's not the answer. It is probably an answer, but it's not the answer. So of course, there's Elon Musk over there on the left-hand side giving us a 2 thumbs up, but you can't see. You can see both of the tops of his thumbs. Going into space, yes, they actually are. I heard Jeff Bezos has bought a ticket, and He got divorced, and now he's launching himself into space. So that's true. Crypto is another one, which is wealthy space nerds. Yeah, that is true. That's true. Crypto. Somebody said to me that they're both bald, but I think that Musk had hair transplant, so he's got a full head now. They're both rich. Yes, they're extraordinarily rich, Julie. They can influence the market. Absolutely. Jesus Christ, these guys should be in jail by the looks of all of these comments that are coming through here. Well, let me tell you something, and here's something that's really bugged me for multiple different reasons. Is just recently, last night, I heard it in the mainstream news in Australia, then went and did some reading elsewhere. So there's been Musk, there's been Bezos. There was also a few others named, founder of Bloomberg. There was our old mate, Warren Buffett, a few others that are sitting there, and they're all named as being the wealthiest people in the world who pay zero or close to $0 in personal tax. And here's the thing, is everyone was getting shitty about it. And I was looking through the comments and everybody's going, they're scumbags, they're arseholes. And I'm thinking, what, are you guys all working for the fucking government? Like, what's going on here? Like, is this not something in some ways to be celebrated? And I get it. I am being provocative, and I understand that. Like, I believe that we should all pay our way, but let's understand something here. I don't know the numbers, but personal tax may be close to zero. Corporate tax, these guys would be paying an absolute mozza, I would think. I don't know, but here's the thing: the amount of jobs that they produce in their businesses, and the amount of tax that's paid by all of the employees, the billions, if not trillions of dollars that's earned by the employees of these businesses that then pay tax, because they had the number. Bezos, 0% tax. Your average American, 14% tax. And as an Australian, I went, 14% tax? Holy shit, I'm moving to America.
Give me some of that. Give me some of that.
14. We don't even start at 14. We start at 19. Thinking, look, so that's it. God, bugger moving to Brisbane, mate. That's it. When the borders open, I'm gone. I'm off to the land of the free. Statue of Liberty, welcome me. But here's the thing: is that I see this, and so don't buy into the bullshit, because and there's a couple of things that I'm going to join the dots to in a moment. I'm going to show you something from back in 1994. Right, and I talk about it ad nauseum all of the time. You've all heard me talk about it, and I really want to share it with you tonight because I'm quite passionate about it. But this stuff comes around, and people. So here's the thing: we should celebrate people being able to minimize their tax. We should celebrate it. The reason why we should celebrate it is we should be every single one of us should be figuring out how we can minimize our tax. And yes, Julie Fletcher, at times, pay the tax and get the loans, but then how else throughout all of the other mechanisms can we minimize our tax? And if we were all focused at a lower level, at the not the Bezos level, and we always go, well, we can't change the world, but we can. But if we go, well, if we're all focused on saving tax and paying less tax, then what is that going to mean? Because here's the thing, these guys know the game. They play the game well, and they're playing the game to minimize their tax wherever they can. We should be celebrating that and going, yes, we need to figure out how to do the same thing, or pressure the governments and basically say, listen, up there, not down here. And so I just want to share something with you, because this has been bandied around. And one of the things that is stopping the biggest taxpayer in Australia, who do you think the biggest taxpayer in Australia is? Just by the way, who do you think the biggest taxpayer in Australia is? Love to know. Do you think it's BHP? Do you think it's Jason? Do you think it's Julie Fletcher? Who do you think the biggest taxpayer is out in Australia? And I'll tell you in a couple of minutes as these come through. But what I'd love to change is I'd love to change our mentality. But Bob's gone me. Yeah, I bet you. I reckon we all feel that way. I am the biggest taxpayer. So the biggest taxpayer in Australia by an absolute freaking country mile is small business. And what I want to share with you and Jace is something I'm very, very passionate about. You're going to hear my voice change a little bit as I just go in order to be able to do this properly. But I just want you to sit back, I want you to listen to this for a few moments, because this is words of wisdom from 1994, and it's as like Jason and I affectionately call, from Uncle Kerry.
At all, that would have been libelous, but that you were minimising tax.
There's nothing wrong with minimising tax. I don't know anybody who doesn't minimise their tax.
And that you were doing so in ways that were contrary to the spirit of the law.
Oh. Well, I just got through telling you what I thought about that. And what you're saying is exactly what the Four Corners program says. I am not evading tax in any way, shape or form. Now, of course I am minimising my tax, and if anybody in this country doesn't minimise their tax, they want their heads ripped. Because as a government, I can tell you, you're not spending it that well that we should be donating extra.
I love it. I love it.
Straight out of the House of Reps inquiry, 1994. Google it. Have a listen to the whole thing, because one of the things that I'm really on my soapbox about, because here's the thing. If we have a look at this is sole trader to small to medium business in Australia, all right? And I'm just going to pop myself over the left-hand side of this for the moment.
Perfect, Andy.
At the bottom, all right? Sole traders are at the bottom. Massive part of our business community. Micro businesses, 611,000 micro businesses. But here's the thing, small businesses, 212,000 small businesses. What we don't allow businesses to do in Australia is we don't allow them to get to medium. We do not allow them to get to medium. And one of the reasons why we don't allow them to get to medium is because we are taxed within an inch of our arsehole. We have so many things that work against us. And then the large end of town, the 4,000 large businesses, they're the ones who are figuring out how to minimise their tax. So in the House of Reps inquiry, Kerry was, and a quote or paraphrase of him saying that he had discussions with other offshore companies, and they were talking about the legislation in Australia. You keep changing your legislation. And the companies offshore were basically saying, you can't operate like that. We won't work with you. But ultimately, and that's 100% true. You keep changing the laws, then they won't want to work with Australians. But here's the thing, is it comes back to us, and it comes back to our attitudes and how we want to view the world. Because here's the thing, there's a reason why we only have a small amount of small businesses in Australia. One of those reasons is that the government actually spend a huge amount of money figuring out how to bleed us, because small business is the largest taxpayer in Australia by an absolute country mile. By an absolute, that tiny, tiny part of us and your Joe everybody's on the street, we are the largest taxpayer in Australia by a country mile. And here's the thing, when you start to get as a business above about the 2 million mark, all of a sudden, and it's usually between 2 and 5 million, you know what they do? They go, you're a successful business. Ah, fuck, we better put payroll tax on your butt. Yeah. It's time for payroll tax. Yeah, you're being successful.
It doesn't benefit the employee or the employee. Nobody. None of us get any benefit from it other than the business struggles to pay the bloody.
And the reason why I bring this up is because when I saw the responses as to how people were responding to Musk and Bezos and everybody out there, just sort of berating them for paying the minimal amount of tax possible, I'm sitting there going, actually, our psychology is all messed up. We need to be celebrating that and going, well, no, hang on, let's not bastardize it, because that plays into the politicians' hands. Yeah. Because that plays into the hands. We should all be paying our way. And yes, we should. We should all be paying our way, 100%. I don't believe there's a free world or anything like that. But what I do believe, ladies and gentlemen, is I believe that we should be shifting our perspective, because if we spent more time asking the governments how, or demanding that they lower taxes so we can be more productive, how we can create tax concessions in environments where we can create innovation, where we can bring the resources into small to medium business to allow them to go from small into medium. And one of my points is that we don't have medium business in Australia because it's too hard to operate as a medium business in Australia. Flat out too hard. too much rules, too much regulations, and we need to take a bit of a book from our overseas partners, and we need to squash that. We need to bring down the regulation. We need to bring down the taxes. And the first way I believe that we're going to do that is to change our psychology. And when we see things like these guys are paying zero tax, go, okay, how do we actually get down that path? Because the more that we bastardize them and say that's wrong, is the more that it plays into the hands of those people who want to tax us. And so my fundamental belief, my happy bloody Friday pill is, ladies and gentlemen, let's celebrate when people can figure out ways of being able to put more money in the pocket of people, meaning the employees of the company. How many thousands of people do you think those two, I was going to say pricks, what do you think those people, how many thousands of people do you think that they employ? And they're paying their 14% tax. And in Australia,
super guarantees and Andy, you know, at the end of the day, money's not, you know, money doesn't get taken off the table. And this is the thing. This is probably that education piece, really, at the end of the day. Cash flowing into a business and into other people's wealth, the people who work there, the business owner. Yeah, let's say, you know, Elon pocketed, you know, 100 million in profit. Well, he's not sitting on it. He's not like, oh, you know what, I'll put that in the safe. You know, what's he starting? He's starting the boring company. He's starting a space company. He's starting a company to build solar panels. You know,
it's interesting that you say that, mate, because what happened was somebody leaked out the personal tax reports. And so Elon Musk, and I'll paraphrase from, I can't remember the publication, but you can Google it. And they said he paid no tax because he used a multi-billion-dollar write-off from the losses of SpaceX, which basically means that he paid billions of dollars into innovation, production, wages, and things like that, lost a ton of money because it didn't go anywhere, and he offset that against his income. And here's the thing. If that's you, you should too. And he's taking risks and he's out there. And I know that there's the other side of it. And please, I get it. It goes too far. And the pendulum always swings too far. What I'm talking about with Jace here is actually just a shift of our perspectives of how we look at it, because we should be taking risks. And you out there, you should be looking at yourself and going, how do I minimize my tax? And what are the things that I can do to minimize my tax? And
how do I minimize my tax, Andy? And one of the things that I'm actually a massive fan of right now, you and I talked about this, is interest rates being low, because that stops that very few wealthy people sitting on cash in bank accounts. And the cash now moves out and it starts creating jobs and stuff. And I'm a big fan of it. I think interest rates should be low for a long time. It makes money move. It makes money come out. It forces governments and everyone to keep the money moving, which creates jobs, opportunity, entrepreneurialism, you know, you name it. So, you know, like I'm a big fan of that.
100%.
Yeah.
Pay less tax. And as Uncle Kerry says, if you're not trying to minimize your tax, you need your head read, because quite frankly, and they're demonstrating it right now, they're not spending it that wisely that we should be donating extra. And so my tip to you right now is that it is tax time. And so all of you should actually be looking at where you're positioned right now. Jason and I have warned you for the last 3 months that the tax time is coming. So if you haven't already, you've got 2 more weeks, a little bit over, to start to sort that out. Pay the attention. Don't bitch and moan if you never look to try and change it. And so here's the last warning for the year, because we're going to jump onto other stuff outside of tax in the future. But minimize your tax, figure out the ways of being able to do it that suit your way and way of life. But also, you know, have a bit to say when people start to talk about these people who are minimizing their tax. And when it comes to voting and all of those sorts of things, maybe these are the things that you should be bringing up with your local member as well, whether it be council rates, whether it be company tax rates, whether it be personal tax rates, whether it be all of these things. Just remember that the squeaky wheel gathers the moss, and I probably completely screwed up that saying.
Yeah, mate, you messed up 2. I don't know what are they called. You know, acronyms.
Yeah, I meshed the 2 of them together.
Yeah, you put the squeaky and the moss together. No, mate, it didn't work.
But if we don't do anything, no change, no change. And let's be a little bit united about this, so that we've got a united front. Doesn't matter whether you're Liberal, Labor, Green, Pauline Hanson, which way you go, right? It doesn't matter. It's all the same agenda when it comes to tax. In that, let's just not spend it if we don't need to, and if we're going to donate more, let's make sure that it's on our terms and in the right way, and let's push for the right result.
Dead right, mate. It feeds right into the property world. If we can minimise our personal tax, we redonate via capital gains tax, stamp duty, GST and land tax. So don't worry, folks. I like the idea of consumption tax. I like GST. I think it's a great tax in comparison to, income tax. Lower the income tax and then just charge people. There we go. Shay's right onto this for us, Andy. It's a metaphor. I knew. We got our producer here. We got our producer. Shay is all over it like a rash. I don't know if that's a good metaphor, Shay, but the Rolling Stone gathers no moss, Andy.
That's it.
And then the squeaky wheel gets the oil. All right, there you go. Well, we might call it done and dusted, Andy Fenton, on the back of getting our metaphors mixed. Maybe we have had a little bit too much wine and the wisdom is fading here this evening. But folks, you can feel the passion. We're totally 100% passionate about you, supporting you and what you're up to in the world of property and the world of business and the world of your financial plan. So if you need some help, let us know. Shay's got, she's right in there. Rashes are generally hot, so I'll take it. There you go. You are hot, my love. But we'll keep that to, this is a PG show. We'll keep that other show for later on. But Andy, absolutely fantastic to hang out with you on a Friday. To the fat. Great to have you folks dialing in today. Alison, Julie, Candace, Bob. Who else we got there? We got where we go up there. We got about 20 or 30 still on Brian. I'm just trying to see all the names. Michelle, if I've missed you, give us a shout out. Team, gang, Chris, hopefully Anita, hopefully Ben, Sean, Kevin, etc., Peter. There you go, Aaron. Plenty of people still on today. So, hey, thanks for joining us, folks. Really appreciate you hanging out on a Friday night. Hopefully we had a bit of fun together and we added some value and, give the government a bit of curry. That's for sure, Graham. All right, gang, we'll call it done and dusted. Wealth, Wine and Wisdom over and out. 50 episodes, Andy Fenton. Well done, mate. What an achievement.
Congratulations. Yeah. Well, let's keep on batting.
all good. All right, folks, you guys have an awesome weekend. Love you and leave you. Take care, stay safe, and bye for now. And it's good night from me.
And it's good night from him.